This is how the company behind Jeep, Ram, Dodge, and Chrysler managed to lose $26 billion in a single year, all while sitting on almost $50 billion in cash. That number landed in February 2026 when Stellantis reported a full-year net loss of $26.3 billion. Not a rough quarter, not a stock dip, but the first annual loss in the company's entire history, arriving just 2 years after a record profit of nearly $20 billion. The swing between those two numbers adds up to almost $46 billion, and the speed of it caught Wall Street completely off guard. So the question becomes, how does a company selling Wranglers, Rams, Grand Cherokees, and Chargers fall this hard and this fast? We're going to walk through the decisions, the people, and the exact moments that turned one of the most profitable automakers on the planet into the biggest collapse the car industry has seen in years. There are details in this story that most people haven't heard, including a $4 billion battery factory that sold for $100, and we'll get to all of it. But understanding how $26 billion disappeared starts with the man who ran the show and what he did to the brands you care about. Stellantis came into existence on January 16, 2021, through a 50-50 merger between Fiat Chrysler Automobiles and France's group PSA, the company behind Peugeot. Valued at about $52 billion, the deal created a 14-brand empire spanning Jeep, Ram, Dodge, Chrysler, Maserati, Alfa Romeo, Fiat, Peugeot, Citroën, Opel, and more, with 300,000 employees spread across 30 countries. Carlos Tavares, a Portuguese executive who had rescued PSA and pulled Opel back from near death, took the wheel as CEO, a protege of Carlos Ghosn, the infamous Nissan-Renault boss. Tavares looked like the perfect operator for a company this sprawling. And for the first 2 years, the results backed him up completely. By 2023, Stellantis posted record numbers across the board, with revenues of roughly $223 billion, a net profit close to $22 billion, and an operating margin above 12%. Merger synergies topped $8 billion. The stock peaked at an all-time high in March of 2024, and investors treated Tavares like a genius. What nobody was paying attention to, though, was what was actually happening on American dealer lots, and that's where this story turns. While Stellantis celebrated those record profits, U.S. market share was quietly falling apart, sliding from roughly 13% down toward 8%. Sales had been declining every single year since 2018, 7 straight years without a single uptick, and the way the company masked that decline tells you everything about its strategy. Tavares pushed prices higher and higher while cutting affordable trims, which meant record profits on paper even as volume kept shrinking. The problem was what that strategy left behind on the ground. Average Stellantis vehicles sat on dealer lots for about 117 days, more than double the industry average. By the middle of 2024, U.S. dealer inventory had swelled past 430,000 units. At its worst point, Stellantis held roughly 17% of all U.S. dealer inventory against only about 10% of actual sales, which meant lots were packed with cars that nobody was buying at those prices. Dealers watched this unfold in real time, and their patience ran out publicly. Jeep, the crown jewel of the entire portfolio, watched U.S. sales fall for roughly 6 straight years. Grand Cherokee volume dropped 12% in 2024, and the Cherokee had been discontinued entirely, leaving a gap in the lineup with nothing to fill it. Ram's combined pickup sales slid 7% that same year, and the much-anticipated all-electric Ram 1500 ended up canceled outright rather than delayed. Over at Dodge, Durango sales fell 14%, while the gas-powered Charger and Challenger relaunch kept getting pushed back, leaving showrooms bare where those cars used to sit. Chrysler's situation told the bleakest story of all, reduced to selling one vehicle, the minivan, and nothing else. One of America's original car companies operating with a single nameplate. And then there was Maserati, which entered something close to total freefall. Italian sales collapsed 42%, and production at the Mirafiori plant dropped 74%, from about 8,600 units down to roughly 2,200. At the Modena plant, MC20 supercar production cratered 79%, falling from over 1,200 units to just 260, making the fourth quarter of 2024 Maserati's worst since 2012. Every brand was bleeding, and all of it unfolded while the CEO collected $39.5 million a year in compensation. That $39.5 million pay package for 2023 made Carlos Tavares the highest-paid traditional auto executive on the planet, a 56% raise over the prior year. To put that in perspective, he earned 518 times what the average Stellantis employee brought home. When pressed on the number, Tavares pushed back without hesitation, saying, quote, "There's a contract between the company and myself, just as there are contracts for soccer players and for Formula One drivers. 90% of my salary depends on the company's results, and this goes to show they aren't that bad." Those results were about to crater. On September 30th, 2024, Stellantis slashed its full-year guidance, cutting the operating margin forecast from double digits down to between 5.5% and 7%, and warning that free cash flow would swing negative by $5 to $10 billion. A single announcement turned the picture from rosy to catastrophic. Third-quarter numbers confirmed the damage, with revenue falling 27% and North American revenue plunging 42%. Global shipments dropped 20%, over 1 million units, and North America alone lost roughly 170,000 vehicles. 2 months after that guidance cut, on December 1st, 2024, Carlos Tavares resigned with immediate effect. Henry de Castries, the board's senior independent director, offered a terse explanation, saying, "Different views have emerged." Sources at CNBC reported that Tavares himself acknowledged making what he called arrogant mistakes, and UAW President Shawn Fain described the resignation as a major step in the right direction for a company. What stings about the exit is the money. Despite being pushed out, Tavares still collected about $24 million in 2024 compensation, plus a separation package worth roughly $12.5 million, which included a $10 million performance incentive. All of that for the year profits fell 70%. With Tavares gone, Chairman John Elkann, the Agnelli family heir who also chairs Ferrari, assembled an interim executive committee to steady the ship. What they found when they opened the books turned out to be staggering. February 6, 2026 brought the bomb. Stellantis disclosed a write-down of approximately $26 billion covering the second half of 2025 alone, with full-year unusual charges totaling roughly $30 billion and a net loss of $26.3 billion. Most of that write-down traced back to the failed all-in electric vehicle strategy. Under Tavares, the company had committed to Dare Forward 2030, a plan targeting 100% EV sales in Europe and 50% in the US by 2030, backed by about $58 billion in electrification spending. That bet landed right as global EV demand started cooling. The charges also covered a $4.8 billion change in warranty provisions tied partly to quality problems from years of aggressive cost-cutting, along with shutting down the company's hydrogen fuel cell program entirely. To be clear about what this number represents and what it doesn't, The $26 billion was overwhelmingly a non-cash accounting write-down. Stellantis ended 2025 with about $46 billion in available liquidity, and only about $7.5 billion of the charges involved actual cash payments spread over 4 years. Bankruptcy was never on the table. What was on the table, though, was a business barely running above zero. Strip away every one-time charge, and Stellantis still posted an adjusted operating loss of about $1 billion on revenues near $180 billion. A company that carried a 12.8% margin in 2023 had fallen to negative 0.5%. Stellantis wasn't the only automaker absorbing this kind of hit. Ford had already taken about $19.5 billion in EV losses, GM roughly $7 billion, and together the three Detroit-aligned automakers have now swallowed approximately $53 billion in EV strategy write-downs. Financial headlines capture the scale, but for the people who build these vehicles, the collapse landed on a personal level. In Toledo, Ohio, where the Jeep Wrangler and Gladiator roll off the line, roughly 1,100 to 1,200 workers faced indefinite layoffs after Stellantis cut a shift in late 2024. Supplier plants nearby took hits too, with Mobi's cutting around 210 jobs and KUKA eliminating about 160. Detroit's assembly complex building, the Jeep Grand Cherokee, saw up to 2,465 workers face layoffs. Down in Belvidere, Illinois, a plant that had been idle since 2022 became the center of a bitter fight. Stellantis had promised a $3.2 billion battery plant and a mid-sized truck as part of a 2023 UAW contract, committing $19 billion in U.S. investment and about 5,000 jobs. But those plans stalled out, triggering union grievances and a strike authorization vote that passed with over 90% support. Across the Atlantic in Luton, England, a 120-year-old Vauxhall van plant shut its doors on March 28, 2025, wiping out about 1,100 jobs and dealing an estimated $365 million blow to the local economy. Roughly 3,000 workers in Italy accepted voluntary redundancy packages, about 7.5% of the Italian workforce, while union sources pointed to threats of up to 12,000 total job cuts. The number that captures the worker side of this collapse better than any other is the profit-sharing check. In 2024, each of the roughly 38,000 eligible UAW workers received about $3,780, down from nearly $13,860 the year before. For 2025, after North America posted a $2.2 billion loss, those checks came to zero. Not a reduced amount, nothing at all, and the former CEO collected $12.5 million just to walk away. One transaction from this entire saga stands out as almost impossible to believe. In February 2026, Stellantis sold its 49% stake in Next Star Energy, a Canadian battery joint venture with LG Energy Solution, for $100. The original investment ran approximately $4.8 billion, and the sale price came to $100. That single deal captures how completely the EV bet collapsed. Demand didn't just slow down. The entire strategic foundation had to be abandoned and written off, and a $100 price tag on a multi-billion-dollar asset is what abandonment looks like on paper. Antonio Filosa took over as CEO on June 23, 2025, after being named to the role on May 28. A 25-year company veteran, Filosa started his career on the night shift as a paint shop supervisor in Spain and rose through the ranks as a protege of the late Sergio Marchionne, the legendary Fiat Chrysler chief who used to call his young executives kids. Before stepping into the top job, Filosa ran the Jeep brand and served as North America COO, and his first-year compensation landed at about $6.4 million, a fraction of what Tavares had been pulling down. The strategic reversal came fast. Filosa abandoned the all-EV push and brought back what customers had been asking for, specifically V8 engines, hybrids, and affordable gas-powered vehicles. A target of 9 U.S. vehicles priced under $40,000, with 2 under $30,000, by 2030 signaled a complete philosophical U-turn. Early returns suggest the shift is gaining traction. Fourth quarter 2025 North American shipments climbed 43% year-over-year, with orders jumping nearly 150%. Jeep snapped its years-long losing streak with a 4% U.S. sales rise in that quarter, and by the first quarter of 2026, Stellantis posted a small net profit of about $430 million, reversing a loss from the same period a year earlier. Filosa unveiled the Fastlane 2030 plan at a Capital Markets Day in Auburn Hills in May of 2026, laying out a $69.7 billion 5-year investment with 60% earmarked for North America, funding over 60 new vehicles plus 50 refreshes. Revenue targets call for growth from about $180 billion to roughly $220 billion by 2030, alongside a 7% operating margin and positive free cash flow by 2027. Bruce Baumhauer, president of Toledo's UAW Local 12, captured the mood on the ground when he told reporters, "New leadership comes in, lowers prices, and dealers are happy, and we're happy. It's all changed dramatically. It's all for the good." Not everyone shares that optimism, though. Bank of America analyst Horst Schneider downgraded the stock to underperform, noting that improvements were starting to help, but did not prove a sustainable turnaround. Bernstein's Stephen Reitman pointed to the chasm that Stellantis management needs to bridge to re-establish trust, and Auto Forecast Solutions analyst Sam Fiorani called the 2030 targets highly optimistic, adding that all of the stars have to align. What makes this story hit so hard is what didn't cause it. No recession triggered the decline. Demand for Stellantis vehicles didn't vanish overnight. The collapse came from choices, specifically jacking up prices, gutting affordable options, betting everything on an EV future that wasn't ready, and ignoring the dealers and workers who kept raising the alarm year after year. Nearly $20 billion in profit in 2023, followed by a $26 billion loss in 2025, adds up to a $46 billion swing in just 2 years. New leadership is saying the right things, and the first quarter 2026 numbers point in a better direction. But free cash flow isn't expected to turn positive until 2027. The analyst community remains split, and the damage done to brands like Chrysler, Maserati, and Dodge won't be repaired in a single product cycle. For the workers in Toledo, Detroit, Belvidere, and every other plant who build these vehicles, the workers whose profit-sharing checks went from nearly $14,000 to zero, the question isn't whether the stock recovers. The question is whether the people now in charge have actually learned something. This was called the biggest automotive collapse nobody saw coming, but the dealers saw it coming, the workers saw it coming, and the union saw it coming. They all sounded the alarm, and the only people who missed it were the ones collecting the biggest paychecks to pay attention. If this video gave you a new perspective, subscribe for more updates on this story, and let us know in the comments, can Stellantis turn things around, or is it already too late?